Do you want to start investing in the stock market but feel overwhelmed, confused, or maybe even scared of losing money? I get it, and trust me, you are not alone. The good news, you don't need to be rich to invest in the stock market. You don't need a finance degree, and you definitely don't need to be glued to CNBC all day to successfully invest. In this video, I am breaking down exactly how you can start investing in the stock market, even if you're starting with as little as $100 or $0. So grab your notebook or open up your notes app because we are about to make investing simple, smart, and actually fun. Investing in the stock market is one of the most powerful ways to build wealth. It helps your money grow over time, beat inflation, and opens doors to passive income. Imagine this. Investing just $100 every month into a simple index fund. Over 30 years, that could grow into over $170,000. That's the magic of compounding. Your money earns returns, and then those returns and returns. It's like a snowball rolling down a hill, gaining momentum. Starting early is key. The sooner you begin, the more time your money has to grow and outpace inflation. While you're busy building your career, your investments are working for you, creating opportunities for passive income. Think about it. $100 a month might seem small, but over time it transforms into a significant nest egg. So why wait? Start today and let the power of compounding do the heavy lifting for you. I am Onuaku, founder of Wealthy Gen, and your go-to girl for personal finance and business tips. And today we are taking the stress out of starting your investing journey. But first, let's understand the basics in plain English. The stock market is like a bustling marketplace, but instead of trading fruits and vegetables, we are trading pieces of companies. When you buy a share of Apple, you are not just making an investment, you are owning a small part of one of the most innovative companies out there. Every time you use your iPhone or tap into an Apple service, you are contributing to that success story. The value of your shares can fluctuate based on the company's performance, influenced by everything from exciting new product launches to global events. It's a fast-paced world where emotions can run high and every decision can lead to significant gains or losses. By understanding this marketplace, you are not just watching from the sidelines, you are an active player in the game of business, where every trade reflects ambition and the potential for opportunity. So whether you are a seasoned investor or you are just starting out, remember every share tells a story and you are a part of that narrative. Here are a few quick terms you should know of before you start investing. A stock is an ownership in one company. An ETF, short for exchange traded fund, is a bundle of stocks, like a playlist of companies. An index fund is a type of ETF that follows the performance of the stock market, like the S&P 500. Dividends are payments some companies give you just for holding their stock. A bull market is a period when stock prices are continuously rising or are expected to rise. And then a bear market is a period when stock prices are continuously falling or are expected to fall. Now that you know the basics, before you buy anything, step 2 is to get clear on your goals. Are you investing for retirement, a down payment, or do you want to trade daily in and out to cash in on market dips and gains? Or do you just want to invest to build long-term wealth? Whatever your goals are, be clear on them because that will determine your overall investing strategy. And so you are not just chasing and following any strategy you see out there online. Then step 3 is to ask yourself, how much risk are you comfortable with? There is no shame in being conservative, but it's better to know before the market dips and you panic sell. Panic selling is when you sell off your investments because you are scared of losing money. And that was what happened to one of my clients who came to my program during the COVID-19 crisis. He panic sold one of his holdings because he was scared he was losing value, and he ended up losing over $25,000. A few days later, the price of the stock that he sold started going back up, but he had already sold and lost money on the sale. So do not skip this step. Determine your risk profile and be clear on your goals to help guide you. Next up, you'll need a brokerage account. This is where your investments live. Think of it like a bank account, but for your stocks. A few beginner-friendly options are Robinhood, Fidelity, Charles Schwab, or even apps like SoFi or Webull. Most of these platforms let you open an account in minutes and start investing with as little as $0. How can you invest with $0, you ask? Well, this will be your best strategy if you are just starting to invest. Most people are so scared of losing money that they don't invest at all. But what if there is a way for you to start investing with someone else's money, buying and selling assets until you are comfortable with using your own funds? That's what paper money trades does for you. Several brokerage firms such as Webull, E-Trade, and Charles Schwab's Thinkorswim offer paper trading accounts. Webull provides a demo account with $1 million in virtual money for practicing buying and selling stocks. E-Trade features a simulated trading application with fictitious funds. Charles Schwab's Thinkorswim includes a paper money feature that allows users to practice trading equities, options, futures, even forex. You can practice as much as you want with the paper money until you are comfortable using your own money. So this is what the paper money version of the Thinkorswim looks like. As you can see here, the paper money is activated. After you practice and you think you are comfortable to trade with your own money, you can switch this to live trading. But this is what it looks like when you activate your paper money. Again, everything on here you see on this screen, the charts, the quotes, and everything is real. It's the same price, the same quotes, the same charts you'll see in the live trading environment is what you see on here. The only difference is that you're trading with money that is not yours. You're trading with paper money to enable you to practice. As you can see on the left-hand side here, you have your account value of $200,000. You have option buying power, $200,000. It means you can buy options worth of $200,000 in here. You have $200,000 of Charles Schwab's money to trade and practice with for options. And you have $300,000 stock buying power, so you can buy stock worth of $300,000 that is now your money. You can use this $300,000 to do whatever you want to do in this paper money version. You also have $10,000 available for you to trade on forex. So this is the paper money that you have. As you see here, you have no position yet because you've not spent this money, you've not bought anything. You'll still have your cash of $200,000 here. If you move on to the trade version, this is where you can actually buy or sell any stock that you want. And here we have Tesla. If you want to say, let's say you want to buy Coke, you can search for Coca-Cola here and you see the price of Coca-Cola, $71.92 as of the time of this recording. And here you can sell, you can buy. And you can, at the bottom here, you have your charts that you can analyze, play around with, and do whatever you want to do with it. You can actually buy. If we just hit buy here, you can come down here and change. Let's just say you want to buy, for the sake of it, 20 shares of Coca-Cola. Or you can switch this to sell, whatever you want to do. But we are going to buy at this time. And what we can do here is, let's just switch this to market. And we are going to go over what limits and all of these options mean, but not in this session. But we're just going to show you how you can use the paper version of this solution. So once we select market, we can review and make sure that everything looks okay. This is how much it's going to cost. 20 units of Coca-Cola at that price that we looked at. It's going to cost you $1,439, and what it means is that your buying power will be reduced by that amount. If everything looks okay, you hit send and you just purchased 20 units of Coca-Cola. And if you go back to your positions, you will see that this is open. It's not filled because the market is not open yet. Once the market is open, this will be filled and you will have this. And you can continue to analyze this and monitor and treat this as though it is your real stock. And when you're comfortable, you can switch this to live trading. On the chart section here, you can do your charts. You can do all whatnot, whatever you want to do. Here, practice, practice, practice. This is what this paper money version is meant for. And once you're ready, like I said before, you can switch to live trading whenever you are comfortable. Now for the fun part, choosing what to invest in. If you're brand new, you may consider starting with index funds like Vanguard S&P 500 ETF or Spider S&P 500 ETF, or any ETF that tracks a sector that you believe in. The good thing about investing in ETFs is that they follow the performance of the market. If the market goes up, they go up. If the market goes down, they go down. But on the average, you can expect an annual return of about 10%. And this is because the average stock market return measured by the S&P 500 is generally around 10% annually. You may also invest in dividend stocks that pay regular payouts, either weekly, monthly, quarterly, or even annually. A good investing strategy is to spread your money across different assets and levels of risk. This means don't put all your eggs in one basket. Instead of buying only, let's just say, technology stocks, diversify your investments by purchasing some tech stocks, some utility stocks, and consumer goods stocks, or any other industry that interests you. The key is to diversify your assets and spread your risk as well. Now, whether you are just starting or a seasoned investor, you can never go wrong with using the dollar cost averaging strategy. This is where you invest a fixed amount regularly, no matter how the market is performing. So instead of timing the market every time, which you may never get 100% right anyway, you decide to invest a fixed amount, let's just say $100 every month, in a particular stock. Whether the price is up or down, you invest regardless. Over time, you will see that you've averaged out the cost of that particular stock, so you never buy it too high or too low. Once you are in, you've purchased your stock, your job is to stay consistent and avoid mistakes. Invest monthly, even if it's just $25. The best practice is to automate your investing. That way you stay consistent and never miss investing as you have planned. Here are 3 common beginner mistakes you should avoid. The number 1 mistake is panic selling when the market dips. Know that the market moves in cycles, right? And the ups and downs in market prices are part of the natural economic cycle. It will always happen. So do not panic sell. Instead, determine your risk tolerance level ahead of time and plan your investing strategy around it. For example, if you know that you cannot afford to see your stock value fluctuate such that it can lose up to 10% of its value, then you should select and purchase only stocks that have lower volatility and that are not likely to fluctuate beyond 10%. The number 2 mistake is chasing hype stocks. Instead of chasing hype stocks, take your time to understand your investing strategy. Every investor has his or her own investment strategy and goal. Those drive the kind of stocks they invest in. So rather than chasing hype stocks because everyone else is investing and talking about them, determine your own strategy and goal. Then look for stocks that suit and meet your own investor profile. That's why some people lose money and others make money while investing in the same asset. The number 3 mistake is giving up after a short time. Instead, play the long game. Think of your investments like a garden. It needs time and patience to grow. The stock market is not your enemy. It is full of opportunities. Even when most people are losing money, there are always many opportunities to make money in the stock market. Now, if you are ready to finally start investing and building wealth for your future, let me know in the comments. And if you want help building your first investing plan, let's have a conversation. You've got this. Even if you're nervous, just take the first step. You will thank yourself later. Don't forget to like this video, subscribe, and turn on your post notifications so you never miss a video from me. Remember, this is your wealthy journey moment. Let's make it count. I hope this video helps you. Thanks for being here, and I will see you on the next one.